Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to using ratios to create a balance sheet. So in essence, we're going to go in the reverse order once again, meaning typically we take the financial statements, balance sheet, and income statement, create the ratios from it for analytical purposes. Now, we're going to be taking the ratios and backing back into the accounts on the balance sheet. This is useful for multiple different reasons. One is that you're basically deconstructing the analysis that you would typically do. You're going from the reverse order. In doing so, you will understand the ratios better. If you're taking test questions, they will often ask questions to kind of back into the ratios instead of just having you calculate the actual ratios. So those are a couple of reasons it's really useful to do practice problems such as this. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you'd like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 343 Use Ratios to Create a Balance Sheet tab in the Practice Problems section. Closing this back up, we're going to have our information up top. We're going to go through that information all at once, and then we'll take components of that information as we work through the practice problem. So what we are given, we're given the total assets turnover, we're given the cash to total assets, we're given the accounts receivable turnover using sales as opposed to cost of goods sold in the calculation, inventory turnover, current ratio, debt to total assets, and sales. So we're going to take this information and do kind of the reverse that what we would normally do. When you're learning this stuff, you'll typically learn it from the financial statements to the ratio. We're taking the ratios and backing back into the financial statements. This might also be useful in practice if you were to take these ratios and do some kind of projections into the future to be, to seeing or estimating what might happen in the future. Okay, so let's go on down the items that we will have. We're going to take a look at the total assets turnover. So, and note, if you're going to be creating, we're going to create a balance sheet with this information. Just realize that you might start from the balance sheet and then look at this from top to bottom. You might say, hey, well, cash is the first line item. How can I figure out cash from this set of data? Looking at the end result, what you want to get to, and then going back to the data. I wouldn't recommend that being the approach in something like this. The approach that would be easier is to take this information and put it in the format that you understand it, look for the unknowns, and then start filling in the puzzle pieces. So start filling in the puzzle pieces that are easiest to figure out first, as opposed to trying to find out the particular piece that you want to get to and then going at that. So that means we're just going to go through these ratios. We're going to basically write down the information we have with them. Then we'll look for any unknowns. So if I can get all the data except for one piece unknown, then we can solve for the unknown piece, which will most likely back us into some component that we will need for the balance sheet. As we get more components that we will put together, we will more likely be able to construct the balance sheet. So it's just kind of like a puzzle here, and that's how I would approach it with these types of problems. So we're going to start looking at some of these ratios. We're going to say, all right, the total assets turnover, they gave us the answer to that, or the end result of that. Sales, they said that the sales were the 678,000 all credit sales. This is just a summary of the data down below. And then we've got the total assets. So the total assets are going to be the balance sheet item. So remember, sales income statement item, the total assets balance sheet item, timing difference. Therefore, you might see this ratio in the format of sales divided by average total assets. So just be aware of that. And then we don't know the total assets. That's the unknown. I have it yellow here. I have the answer in there, but just note that it's yellow, indicating that we don't know that. That would be the unknown. And then we have the total asset turnover. That's what was given. The total asset turnover being the 1.8. So I would write it vertically, then indicate the item that I don't know, because that's how I visualize it in my mind, and then write it algebraically on a piece of paper, because that would be the easiest way to solve it, which would be the 678,000 divided by x equaling the 1.8. So notice as we go through this practice problem, there will be rounding, and I highly recommend doing this in Excel, because I'm going to show you how to use some tools like GoalSeek, and you'll also see some of these rounding tools that you want to be aware of as you do these analysis. So just be aware that you might have some small differences due to rounding, because I used GoalSeek to come up with these numbers in Excel, And again, you want to practice with Excel to be okay with that, and be okay with the fact that there's going to be rounding involved anytime we use these ratios, at least in practice, unless the problem is completely perfectly set up to be rounded right where it needs to be. Okay, so now we're going to take the 678,000 divided by the 1.8, and that's going to give us our 376, and notice it's 666 as opposed to 629. And again, that's because I used goal seek in order to find this in Excel. But note, if you calculate it this way, the 678,000, and we divide by the 376,629, then we get the 1.8, but not exactly. It's rounded here. So there's going to be rounding errors, and I want you to kind of see that as we go to the goal seek. Note that that's not really a problem in practice, because when you have these rounding kind of errors or these rounding differences, in practice, you're using these ratios as an estimate in and of themselves to project something in the future. If you're using a book problem, however, then you're going to have to note when there's a rounding problem so that you can select the best answer of a 4-choice multiple question. Okay, so then let's go to the next piece here. We're going to say now we've got the cash to total assets. Cash to total assets, let's move this out of the way, is going to be the unknown is cash. Now this ratio is just how it sounds, cash compared to the total assets. The cash is going to be unknown, and now we know the total assets because we just figured it out up top. So the total assets is going to be this 376,629. That's what we're going to use for it. And again, remember that there's rounding, involved in that calculation, and that's going to give us then what they gave us is the 1.7, so 1.7%. So the unknown would then be the yellow item, which we can then write algebraically, which would be x divided by the 376,629 would equal, and if we make the percent a decimal, moving the decimal 2 places over, it would be 0.017. So then we would solve for that. You could solve for it algebraically here, and that would look something like this. We're going to take the 376,629 times, and then I'll put this in a decimal format, 0.017, and that's going to give us our 6403 about. So notice again, rounding involved here, 6403 about. If you were to use this cell in Excel to calculate something else, it would actually calculate using the actual number, even though we're rounded to 3 here. If you're using a test question problem, then they're going to have to round it somewhere. You might say, I'm going to round it to the dollar or to the penny or something like that, which again will result in rounding differences. So that's just a factor of using ratios. So then we're going to go down and we got the accounts receivable turnover. That's the next item. They say it's 8 times. So we'll get the calculation for the accounts receivable turnover, which is going to be the sales, top line of the income statement, divided by the accounts receivable. We're comparing something that's an income statement account and a balance sheet account. Therefore, you might see this ratio as sales divided by average accounts receivable, as we've seen in the past. I won't go into detail on that. And then they gave us the total, which is the accounts receivable turnover of 8. So the sales is something that we knew, and we knew the 8 here. The yellow item was the unknown, which I would then write first out in a vertical fashion, then write it out algebraically, which would be the 678,000 divided by x, the unknown, equaling then 8. And then we can basically solve for that algebraically, which would look something like this, the 678,000, and we're going to take that and divide it by the 84,748, and that's going to give us the 8 about. So wait a second, let me do that again. This 678,000, and then we're going to divide it by 8, and that's going to give us the 84,748. And notice I got 84,750 here. So there's a slight difference there. Why? Because we used goal seek in order to find this in Excel, and goal seek is going to round it to like 4 decimals out to basically find the answer through trial and error. So in other words, if you were to take the calculation or double check the calculation here, 678,000 divided by the 84,748, you're going to get 8 about, and notice it rounds it out to 4 decimals. So again, I highly recommend going into Excel just to see that tool of goal seek and just to get used to working with these rounding tools in an Excel worksheet, which is probably the most appropriate place to be using with these types of ratios, especially if you're doing projections into the future to get used to them. Okay, so we're going to be using this 84,748. Then we have the inventory turnover using sales as opposed to cost of goods sold. Therefore, we have sales as opposed to cost of goods sold divided by the inventory amount. Notice we have, once again, a turnover ratio. Therefore, we have an income statement account, a balance sheet account. Therefore, you might see this as average inventory, depending on the context that you are working in. And that's going to give us the inventory turnover. What was given to us? Well, we had the sales. We still got the sales. And we were given the inventory turnover of the 10 times. Then the inventory is going to be the unknown, which we could back into. That's going to be an amount on the balance sheet that we're going to need. Therefore, now we can write it down algebraically, which is what I would do. 678,000 divided by X is going to be equal to 10. And then we could basically do the algebra on it. So we're going to say, all right, then you're going to take the 678 divided by 10, and that's going to be the 67,800. So then you could double check it. You could say, all right, if I took the 678,000 divided by 67800, that's going to give us our 10 here. So there we have that item. Let's take a look at what else we can put together here. We've got the current ratio. Next item, they gave us the current ratio. The current ratio is calculated as current assets divided by current liabilities, both balance sheet items. Therefore, no timing difference, no average thing that we need to do. That's going to give us the current ratio. So that's going to be the current assets. Now you might say, well, I don't see current assets here, but we can take a look at what we have so far and say maybe I can kind of back into the current assets. So let's see what we can do here. If I go back up, let's go all the way to the top. I'm going to say, what have we figured out here? We've got the total assets. We know that. We know cash. That's going to be a current asset, 6403. And we figured out accounts receivable. That's a current asset, 84748. And we figured out inventory, a current asset, which is going to be 67,800. And that's going to give us our 158,951. So we're going to assume, this is an assumption we had to make in the problem here, that are all the current assets that we have, which is going to add up to the 158,951. And then the current liabilities is what we do not know then. We don't know the current liabilities. We do know the ratio. That's what's given to us. It's going to be the 1.86. Therefore, we can solve for the yellow unknown. We would write it out algebraically to do so. So I would write it out as 158,951 divided by X, the unknown, is going to give us that 1.86. Then if we solve for that algebraically, it would look something like this. 158,951 divided by 1.86. And we're going to get 54,450. And notice I get 7 here, or 8 even. And here I've got 55. Why? Because we used goal seek in order to figure this out, which rounded basically the answer out through trial and error to like the 5th decimal. So again, practice that in Excel. Take a look at it in Excel so you can kind of see those two calculations. But if you were to then check the number here, we got, okay, 158,951. I missed the number here. 158,951 divided by the 85,455. And you get to 1.86 about, rounded out to like 5 decimals here. Because again, goal seek was used. Estimating is going to be involved, somewhere with when you're calculating the ratio. So take a look at that tool on that. We're going to be taking the 85,455 for the current liabilities. Then we got the debt to total assets. So that is exactly what it sounds like, meaning we're going to pick up the debt liabilities, compare that to the total assets number, and that's going to give us our debt to total assets. Now, the total assets we know because the total assets we did up top. Let's see. Let's just check it out here. Total assets we did with the total asset turnover. So that 376,629 is now going to be, that's going to be this 376,629. And they gave us the debt to total assets, which is the 45%. The unknown then is the debt, which we're going to say is liabilities. So we can write this out algebraically, which would be X divided by 376,629 would equal, I'm going to move the decimal 2 places over to get to 0.45 representing the 45% in decimal format. Then we can solve for this algebraically, which would be, okay, we're going to take the 376,629, we're going to multiply it times in decimal format 0.45. That's going to give us the 169,483 about, right? So about, always dealing with the rounding. Now, if I was to double check it, 169,483 divided by the 376,629, if we move the decimal over, is going to be about 45%. So again, always dealing with rounding in these types of problems in some way. Then we're going to go to the total assets now. The total assets we know are going to be the current assets and the fixed assets, otherwise known as the property, plant, and equipment. This is another assumption we're going to kind of make here. We're saying the total assets is going to consist of, if you think about the asset portion of the balance sheet, current assets, and then long-term assets usually being the property, plant, and equipment being the only long-term type of assets oftentimes. So that means that if we take the current assets, which we figured up top with the current ratio, we had the current, so 158,951, scrolling back down, we're going to say, okay, so the current assets, 158,951, fixed assets we don't know, property, plant, and equipment being the fixed assets, and then the total assets we had up top, that's the first thing we did. If we go all the way up top here, we're going to say total assets we calculated here, total assets and the total asset turnover, the 376,629, scrolling back down, we see that here, 376,629, so the unknown being the fixed assets. If we write that out algebraically, then we got the 158,951 plus x is going to be the 376,629. So then we're going to solve for x, which will be the fixed items. So we're going to take then the 158,951 minus the 376,629, and that's going to give us our 217,678. If we double check our number, then 158,951 plus the 217,678 is going to give us our 376,629. All right, then the next item, we got the total debt. We're going to figure out the total debt, and so that's going to be consisting of the current liabilities plus the long-term debt, and that's going to give us our total debt here. So the current liabilities we figured out up top. Current liabilities we figured out, we have it in the current ratio. Current liabilities 85,455. So there's going to be the 85,455, and the total debt we figured out up top. The total debt being the 169,483. So that's going to be the 169,483. The thing we don't know then is the long-term debt that we want to pull out. So that's going to be our equation. So that'll be 85,455 plus x, if we do this algebraically, equals the 169,483. Then we could solve for this algebraically. We can then say, all right, we've got the 169,483 minus the 85,455. That's going to be the 84,028. If we double check this, it's going to be the 85,455 plus the 84,028. It's going to give us our 169,483. Okay, so there's that item. Next thing we need, the equity. We're going to figure the total equity section. And notice these last two, you might not see these ones because we kind of finished up here. We got, at this point in time, debt to total assets. We basically finished off all of our ratios. So you might start, before you did the total asset calculation and before you did the total debt, you might have started actually putting together the financial statement, right? You might have started going, let's just do that now. You say, okay, here's the balance sheet. I can say assets are going to be current assets, include cash. We figured that out up top. So if we scroll up top, we figured up cash. Cash we had here with the cash to total assets. So 6403 on the cash. Then we had the accounts receivable, 84,748. I think that was in the accounts receivable turnover. So if I scroll up top, 84,748 accounts receivable turnover. Then we had the inventory. That was an inventory turnover. So if we scroll back up top, we've got the inventory. So we figured out the 67,800. 67,800. And that's going to give us our total current assets. So we can add these up, and I think we work this. So then once you have these three items, you might then say, okay, now I can figure out, of course, the total current assets. So then you can say total current assets. We're going to add those three up. Then the fixed assets, you'd probably say, well, the next item on the balance sheet would be the fixed assets, right? And this is where you'd probably stop, because notice the fixed assets up top here. If we look at our information, they didn't give us any fixed asset ratio. We stopped at the debt to total assets, but then we can go back up here and say, all right, well, I know that if I calculate the total assets, typically they're going to be the fixed and total assets, right? So I know what the total assets are, therefore I can back into the fixed assets. So we did that on a little worksheet up top, but you might have just done that on the balance sheet, right? You could have said, okay, I don't know that one. It's an unknown right there. But I know that the total assets are this, so then you can kind of back into the fixed assets. You could have done that calculation that we did up top, basically right here, saying I know that current assets plus the fixed assets are going to be total assets. Notice we're not breaking down the fixed assets to the components as you would typically have on a balance sheet, would be costs and accumulated depreciation. So that's kind of a simplified balance sheet we have here. And then we got the liabilities. Current liabilities are going to include the current debt. So current debt, and we are including all, normally current liabilities might include multiple things like accounts payable and any other kind of payable. We're lumping them all together as current debt as we do our ratio analysis. So again, that's a bit of a shortening of the items. And obviously if we look at the current debt, we did that on the current ratio. When we did the current ratio, the 85,455 current liabilities. So that's going to be 85,455. We could have just called it current liabilities. We're not breaking it out into their subcategorizations, which would typically be like accounts receivable and so on. Then we knew the long-term debt. So the long-term debt, we figured up top here, long-term debt. And notice how we did that here. We didn't do that with a ratio. We said, I know the current liabilities and I know the total debt. So we know the total debt. We figured out the total debt, and therefore we might have done that. You might have done that just on the balance sheet. If you're trying to make the balance sheet from what we had from the ratios, you'd say, okay, here's the current debt, and I know what total liabilities are. I don't know what the long-term liabilities, so I could back into it, right? So you might just do that calculation. We did it up top in a little formula. You might do it just basically right here. And then we have the equity, which once again, we don't know. We don't know the equity. But we do know that the total liabilities in equity are the 376,629, because that's got to be equal to the total assets. So once again, we can kind of back into the equity number, and you'd probably do that while you construct basically the balance sheet. But then we'll pull that out in a separate calculation here for equity. So equity, if we think about the accounting equation, which would be assets minus liabilities, is going to equal equity. So assets minus liabilities equal equity. So we can say, we can obviously subtract this out. We get the 207,146. In other words, if I go back down here, you can calculate this a couple different ways. I know what total liabilities and equity should be because it's equal to assets minus liabilities. So you can think about this as total equity and liabilities, or of course, if you rewrite the accounting equation, assets is the same number, minus liabilities is going to be equity of the 207,146. And so if we put that together, then this thing will balance out, right? We got the cash, accounts receivable, inventory. We've got the current assets plus the fixed assets gives us the total assets. We got the current liabilities, which we grouped together just all in as current debt. We've got the long-term debt, which we grouped in all in as just one debt line item. That gives us the total liabilities. And then we backed into the equity by taking assets minus liabilities and equity. Assets minus liabilities, giving us equity. Therefore, the liabilities plus the equity will equal total liabilities and equity, which will match, of course, the assets.